Howdy everybody and welcome back to another stock analysis video. Today I want to give you guys an update on the company that we already examined a couple months ago, Smiths and Wesson. And well, they recently had earnings and as you can see they did not do pretty good. In fact, their current share price has gone down from $17 to around $14.36 as of post-market close. So I want to reanalyze this and see if this is still a buy, because last time we took a look at this, it was a pretty good buy. So maybe we got more value here and there now that the stock has fallen. So I want to analyze it. So with that said, let's get started with this video. Actually, before we get started guys, I would just like to say thank you so much for the interaction I've gotten on my Luck Oil video. 381 views, that is a lot of views, and even 28 comments in total. That's awesome. Was not expecting this kind of reply, but then again, it is a pretty popular topic right now that's going on in the news with Luck Oil and Russia and Ukraine, all this stuff. So thank you for all of you guys that commented, viewed, and subscribed as well. So that's pretty much all I wanted to say with that. Now let's get started with the analysis. Starting off, we got the dividend summary. Smith & Wesson does pay a dividend of around 1.77%, which ends up being only 8 cents a share. And annually, this comes out to be 32 cents. Payout ratio in regards to the net income is around 4.7%, so it's looking pretty good. However, we're going to take a look at this in regards to the cash flow, because companies do not use their income for distributing dividends, they use their free cash flow. So we're going to take a look at this in regards to the cash flow and see how they stack up with that. Now, they do not have a 5-year growth rate, but I think last time we saw this as well, and it was because of the fact that they have not been issuing this dividend for 5 years to have the 5-year growth rate in the first place. Therefore, there's no way that we can have it. However, they have been able to increase it for 1 consecutive year, so let's see how much cash they have on hand after this dividend is paid off, and maybe we can foresee that they'll continue to increase this dividend into the future. Ex-dividend date passed as of December 15th, payout date was January 3rd, and they pay their dividends quarterly. Now let's come over here to the spreadsheet. Ticker symbol of SWBI, market cap of $864 million. So this is a pretty small company, guys. PE of 3.3, not as small as Luck Oil that we just saw yesterday. However, it is still pretty cheap as of the earnings. And well, this pretty much is giving us the idea that at $17 a share, this might be a pretty good buy right now based on their earnings. Now, as we saw with the 32-cent annual dividends per share, this comes out to be around $15 million being paid out in dividends every single year. And after this is paid out, guys, they're still left with around $91 million left in their 5-year average free cash flow, which ends up being around 14.5% as a payout ratio in regards to their free cash flow. Pretty much just saying that they can 100% afford this dividend, and they could even increase it into the future. Now coming over here to the fundamentals, starting with a net income 5 years ago of $128 million to $252 million, which is an increase of 97%. Obviously, guys, 2 years ago, they did negative $61 million. However, let's actually take a look at where this negative $61 million actually came from. And as you can see right here from Seeking Alpha, April 2020, meaning that they pretty much got the brunt of the whole COVID thing, right? So, kind of explainable as to why they did negative income in 2020. What isn't understandable though is what caused them to do $20 million and $18.4 million 3 and 4 years ago, respectively. But nonetheless, this is a positive metric. They are continuing to increase their income, and depending how things go, this might go up into the future. Now let's take a look at the free cash flow. This is the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $88.7 million to 1 year ago of $293 million, which is an increase of 231% with an average 5-year free cash flow of $106 million. Now, same thing that we saw with in regards to the net income is that, well, 1 year ago they did go up. 2 years ago they did pretty bad. However, taking a look at the 2 years ago to the 5 years ago, they were pretty much the same. Again, I can't really explain what caused this decrease in regards to their free cash flow 4 and 3 years ago, where 4 years ago it was $43 million and 3 years ago it was $26 million. I have no idea what caused this, but nonetheless, currently they are up by a significant amount. And there are a couple factors that might explain this, and I'm going to give my opinion as to why this is happening at the end of the video, so make sure you stick around. Next, we got the revenue 5 years ago of $903 million to 1 year ago of $1.1 billion, billion with a B, increase of 17.27%. And we're seeing the exact same thing that we just saw with the other two charts. 5 years ago, pretty good. 1 year ago, very good. In the middle, pretty bad, pretty average, right? Again, can't really explain it except for the 2 years ago because of the whole COVID shutdown fiasco that was happening in the whole entire world. Now let's take a look at the total assets minus the total liabilities. I do not remember if when I first did this company, I had this metric. I'm pretty sure I didn't. So let's actually analyze this company using the analogy that they would liquidate all of their assets and pay off all their liabilities and see how much money they have left after they do this. Currently, Smith & Wesson, if they were to do this hypothetical, they would still have around $230 million left in assets minus liabilities. Not only that, guys, they were pretty solid when it came to their assets and liabilities pretty much all throughout except for 1 year ago where it slightly dipped to $142.6 million. Average assets is around $314 million, average liabilities is around $120 million. Assets minus liabilities in the average, we get around $193.4 million. Now let's take a look at the shares outstanding, the silent killer when it comes to investing. And when I first looked at this, I think this was the reason why I actually fell in love with Smith & Wesson the first time I saw it. Because, well, 5 years ago, they have 54 million shares to today of 48.3 million shares, which on the 5 year is actually a decrease of negative 10.39%. And from the previous to the current year, it is a decrease of 3.21%, which is huge. I mean, just take a look at this. 2 years ago, they have 55.4 million shares, and then boom, 1 year ago, completely brought it down to 49.9 million shares, and then continued to bring it down again to 48.3. This company is not diluting you. Now, obviously, if you were to take a look at 5 years ago to 2 years ago, that would be considered an increase. But then again, they did brought it down, making this metric a positive. So currently, they're not diluting you. And this is a really, really good positive metric. And lastly, we got the cash and equivalents. And as of today, they have around $159 million in cash and equivalents with an average cash and equivalents of $91.5 million. Now let's actually come over here and make some assumptions. Low, median, high with 3 different factors. Growth, predicted share buyback, and required rate of return. The required rate of return, I'm going to keep it the same, 10% all across the board to match the S&P 500. The growth, guys, I'm going to get it from the revenue growth year over year here on Seeking Alpha and the revenue growth forward. Now, as you can see, there's a huge split between the year over year growth and the forward looking. So I'm going to have to pretty much guess in between right here, which explains why for my low assumption, I'm going to assume a growth of 10% with a projected share buyback of 2%. This comes out to be a target share price, not adjusting for debt, of $21.63. For the median assumption, I'm going to say a growth of 12%, projected share buyback of 3%. This comes out to be $23.34. And lastly, for the high assumption, a growth of 14% with a projected share buyback of 4%. This comes out to be $25.17. Now we need to adjust for debt. And the way we do this is we take the cash equivalents that they have and subtract, or add in this case, the net debt. If they have more debt than cash, then clearly the target share price should come down. If they have more cash than debt, then the target share price will come up. So as you can see right here, going from $21.63 to $25 is pretty much telling you that they have a lot more cash than they do debt, which is a really good thing when it comes to analyzing a company. Even a company that has little to no debt. But nonetheless, target share price for the low assumption, adjusting for debt, is around $25. For the median assumption, we get $26.75. And for the high assumption, we get $28.60. Now let's add a margin of safety of 5, 10, and 15%. Just so that way, we do not overpay for something. The more you pay for something today, the less returns you're going to have in the future. I recently just heard an analogy from another channel that I really like to watch. And they pretty much just said, if you are building a bridge and you know that the max capacity that you need is 10,000 pounds, you build that bridge for 15,000 pounds or 20,000 pounds. You do not build it for 10, right? That's the same application that you need to apply here with a margin of safety. So for the low assumption, we would like to buy between $21.25 to $23.75. For the median assumption, we would like to buy between $22.73 to $25.41. And for the high assumption, we would like to buy between $24.31 to $27.17. Guys, the current share price is $17.89. However, I did show you guys in the beginning of the video that post-market, they did go down to like 14. So this is even incorrect to this. If you were to put this as 14, you can pretty much say that you are pretty much in every single sweet spot that you could think, assuming that you believe my assumptions. And again, just like I always say, these are my assumptions. I do not want you to agree with them. I hope that you do not agree with them. You should make your own assumptions. I have this calculator available for free. Go to my discounted free cash flow calculator video, the updated one, and you can get the calculator as you see fit. All I'm asking for in return, guys, is like, subscribe, comment. It really does help her with the algorithm. Share and hit that bell. We just reached 411 subscribers. We are 89 subscribers away from reaching the 500 goal by the end of March. Thank you all very, very much. And as soon as I get up to 500, I want to be making community posts and having you guys like vote on which companies you want to see, which companies you want to analyze, all this stuff. It's going to be great. Can't wait. But nonetheless, the calculator is available. You should not follow my assumptions. You should make your own assumptions because I will never tell anybody what to buy. You put your money wherever you see fit. I'm just giving you the raw data with my assumptions. Now, when it comes to Smith & Wesson, I've clearly said before that I am a gun guy. I love my Second Amendment. I have a lot of guns, and I honestly foresee that this company will not go away. I mean, this is a name brand. And last episode, I even showed a map of the United States year over year on Wikipedia. Anybody can look this up on Wikipedia as to which states are doing constitutional carry throughout the years. And believe it or not, the United States is leaning more and more towards constitutional carry on the state level. In fact, as if I think of June of this year, the Supreme Court is going to rule on whether or not states need to become shall issue when it comes to concealed carry. So if you take into account that we're heading more towards constitutional carry, and if you think that the Supreme Court is actually going to rule that concealed carry has to be shall issue on every single state, you can pretty much just assume that a company that makes guns, a manufacturer of guns, they're probably going to go up on this news. So right now, from what it looks like, this could be a really, really good value play. But then again, my assumptions and my opinion. That pretty much does it for this episode. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my YouTube sites of BitChute, Odyssey, and Rumble. When you do my stock analysis videos and crypto videos, you'll find exclusives as well. In regards to YouTube, Odyssey, and Rumble, I have a Let's Play channel called Fatal Place, where I'm currently playing through Pokemon Legends Arceus. Almost done with the game, so if you want to catch that, the link is in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.